This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Hi. In this lecture, we're going to take a look at accounting issues related to climate change. There was a time, I think, in this exam when all students had to do was to understand very complicated double entry bookkeeping. Those days are well past, so there's no double entry here, which saddens some students, I think. Is it important in life? Obviously. Is it important in the exam? Yes. Will it come up in your exam? Very probably. So group accounts will come up, won't they? And we all spend months practicing our group accounts. Will this come up? I think so. So there's not much here to learn, but it will need learning because it doesn't come instinctively. So I stress this is very important in the syllabus. Now, in terms of background initially, the first thing to understand is that the ISSB Foundation, which is like the parent of the ISSB, they set up a new body known as the ISSB, the International Standards Sustainability Board. As you can see from here, it's a truly international organisation, and their task is to set out sustainability disclosure standards. To date, they've issued 2. They came into force at the start of 2024, and they're certainly firmly in our syllabus. In terms of the difference between them, the examiner has said that S1 at the moment will probably be examined more in theory and S2 a bit more in practice. Now, to be honest, the one you really need to learn is S1, inside out. S2 follows very closely, so it's quite easy then to learn the extra bits for S2. But S1 is the one that matters, and especially make sure you're familiar with the jargon that I go through. So in S1, which is, as it says, disclosure of sustainability related financial information, what's the purpose? Like the purpose generally of financial statements, it's to help the primary users of the accounts understand risks and opportunities which are linked to sustainability of the business. Remember, primary users means investors, it means lenders. It does not mean employees, it does not mean central government. It's the primary users, the people who put money into the company. In the same way, really, as financial statements are primarily intended for primary users, lenders and shareholders. Now, the IASB Foundation are very aware that in some countries they don't use international accounting standards. They might use local standards. So can companies still apply these sustainability standards? And the answer is yes. So in terms of scope, as it says here, whether or not they've used IFRS for the accounts, they can still use these disclosure standards. When you think about other accounting standards, other accounting rules like inventory, related parties or whatever, remember you've got a conceptual framework and then the standard. And this follows the same pattern. So there are conceptual foundations. When you look at these words here that I'm highlighting, they're familiar to you, aren't they? Relevance, faithful representation, comparability, verifiability, timeliness and understandability. You get examined on those anyway, and that's dealt with much earlier in this lecture series with the conceptual framework. So I'm not going to spend long on them, but don't forget you need some sort of mnemonic for them, perhaps. One that I sometimes use is Fred ran under the Chelsea, as in football club, viaduct. I don't know where I got that from. I just made it up one day. As you look at the words though, don't forget that you have this conflict between relevant and faithful representation. Faithful representation is almost historic, isn't it? It's quite easy to faithfully represent things that have happened in the past. These were the fines that we paid to regulators for breach of emissions or something in the past. But what they want to know, really, people, is what's going to happen in the future. And that perhaps that's more about relevance. So commentators would say, faithful representation is about the past, relevance about the future. A particular problem is verifiability. And if you take a number like charitable donations, that's easy to understand, isn't it? Because it would be verifiable by looking at the nominal ledger. But the minute that you say emissions or something like that, you're scratching your head and saying, how on earth could I vouch that number? And in particular, of course, it may be that companies make claims that are simply not verifiable about their environmental impact. That's a process that's known as greenwashing. So giving information, data that simply can't be checked in any sensible way. There we are then. So the conceptual foundations: Fred ran under the Chelsea viaduct, faithful representation, relevance, comparability, timeliness, and understandability. Final point, which I'll just highlight here, is that this is a changing feast, isn't it? So it will be very tempting to give information about different things every year, and we need to make sure that you're getting some measure of consistency in terms of the disclosure. So what is it that must be disclosed? Under the standard, here we are, core content. Now my favourite food is sausages. So I'm going to make a mnemonic up that says, good sausages really matter. So when I go to the supermarket and go to the sausage counter, I say, I want your best sausages, because good sausages really matter. You've got to have those 4 words somewhere in your brain. Not sausage, but strategy, and so on. When you look at it, and you look at the examples of disclosure, it doesn't look very friendly, does it? And that's just how the standard is. But try and see it as a process of drilling down. So governance is like the whole board, the non-executive directors right at the top. Strategy, think about the executive directors making their policy. Perhaps risk management is more down to day-to-day management within the business. Metrics, down to everyone, even down to the delivery driver at DHL, where they minimise their impact by switching their exhaust off or whatever, their engine off. That's how I learned it, really. Governance is like my non-exec directors, my audit committee. Strategy is my exec directors. Risk management, more day-to-day management. Metrics, everyone in the organisation. It's helped me to learn them anyway. So I think for each of them, you certainly, if possible, need to have one disclosure up your sleeve. So what would I go for in terms of the ones that I've mentioned here? Well, the ones that are easy to learn, certainly. So governance, the board will be informed about risks and opportunities relating to sustainability. How are they informed and how often is it discussed? Second tier, strategy. So, well, think about something that's easy to understand. What's the effect of sustainability, risks and opportunities on the accounts? The balance sheet or financial position, performance, P&L, again, and OCI, and cash flows. What's the impact, again, of polluting the river, whatever it happens to be? Down to the third tier, risk management. Which will I go for? Well, I'm just saying, for example, how do you prioritize sustainability risks relative to other types of risk? Is it just a box-ticking exercise when you've done all the other risks that you were bothered about, or does it come high up on your list? And finally, metrics and targets. So, again, clarity about how those metrics are defined. So, if you've got number of serious water leaks, well, what's the definition of serious? And whether the metric is vouched in some way by some sort of assurance provider. That's an easier one perhaps to learn. Finally, on statement number 1, they talk about a statement of compliance. If you comply with the sustainability standards, you say, I comply with the sustainability standards. If you don't comply, you say nothing. So, no nonsense here where people might say, I comply with the standards except for these 9 exceptions. No. Either you're in or you're out. End of story. That's statement 1. Statement 2 drills down from sustainability generally to climate-related disclosures. And really, it largely follows the pattern of Standard 1. So again, it has objectives, scope, core content, exactly the same. So not too much to say here. But within scope, I want you to notice that it talks about climate-related risks, which could be physical or transition. Imagine you've got a factory and it makes diesel cars and you're situated by the river. Because of the flooding, your factory is wrecked. That's a physical risk. So your factory is wrecked. You're also concerned that no one will want to buy your diesel trucks, so you need to change your model to produce things that are hybrid or electric, and that's a transition risk. So as we transition to less carbon usage. So think about that. The first one is the factory by the river. The second is the factory that goes from diesel to electric. The core content is the same. Good sausages really matter, but there's much more specific detail about the individual metrics, and perhaps I would learn a couple. So just a couple that you can understand. So in the bullet points here, most of us are probably struggling with greenhouse gas emissions, but the second and third are fine, aren't they? So how much money have they spent on fixed non-current assets which link to climate change? How much of the bonus of management, again, is what proportion is linked to climate-related issues? That would be learnable. At the start, I said that the IASB Foundation had set up the ISSB. Another organisation or body that's been much involved with this is the Europeans. And in particular, again, if we come down here, there are European sustainability reporting standards, and they're at a slightly later stage of development. The examiner has said they might ask us about the primary differences between the IESB ones or the ISSB and the European ones. So I've highlighted what I regard as 3 major points. Would I learn this? Yes. Will it come up? Yes, it may well, and it will be a very easy way to get 3 or 4 marks. So we've already said that anything produced by the, ISSB, so anything that's IFRS focused, is for primary users. The European Union, though, is much more concerned with everyone. So we, that's the yellow one, are concerned with shareholders and lenders. The European standards are concerned with everyone. So that means governments, all other stakeholders, again, effectively anyone impacted by the business. Second point, because the European standards have been around for longer, there are more European standards. That's easy. And finally, and it's the same theme as number 1, the concept of double materiality. So when we consider what should be disclosed, think about things that would impact investors. Yeah, that's like the IFRS focus, isn't it? But also think about what would be material on everyone else. So the people who live on the beach that's polluted by the big oil company, who certainly aren't investing in the company. So it's the difference there between IFRS style materiality, which is financial, and impact materiality, which is thinking about anyone, again, on whom the company might have an impact. Do make sure you give some time to learning those points. Just at the moment, as long as you've got some bits of the theory sorted out, I'm sure you'll be fine. Thank you.